Hello, and welcome. Today we're diving into a topic that's on everyone's mind: the explosive rise of artificial intelligence and what it means for your money, your investments, and your future. Whether you're a seasoned investor or just starting out, the AI revolution is impossible to ignore. All around us, headlines are buzzing about AI breakthroughs, and investors are scrambling to get a piece of the action. From Wall Street to Main Street, people are asking, is this the next big thing, or just another passing trend? AI is everywhere, promising to revolutionize everything from healthcare, where robots assist in surgeries, to transportation, with self-driving cars, and even factory automation that's changing how products are made. The technology is advancing at lightning speed, and it feels like we're on the brink of a new era. Stock prices for tech companies are soaring to new heights, and investors are piling in, hoping to strike it rich. The excitement is palpable. Everyone wants to be part of the next big wave, and fortunes are being made overnight. But if this all sounds familiar, that's because it is. This excitement feels a lot like the dot-com boom of the late 1990s, when people threw money at anything with .com in its name, convinced that the internet would change everything overnight. Of course, we know how that story ended. The bubble burst hard, wiping out fortunes and sending the Nasdaq down nearly 80%. Many investors were left with nothing but regret, and the scars of that crash still linger today. So, the big question is the AI boom truly a new era of wealth and innovation, or are we simply repeating the mistakes of the past? Are we witnessing a genuine technological revolution, or just another speculative bubble fueled by hype and fear of missing out? The legendary investor Sir John Templeton once warned, "The four most expensive words in investing are, 'This time, it's different.'" It's a reminder that history has a way of repeating itself, especially when greed and excitement take over. That's why it's so important to look past the hype and focus on the facts. By understanding what's really happening, you can make smarter choices and protect your financial future, no matter what the market does next. In this chapter, we'll break down 3 major warning signs that suggest this AI surge could be a bubble. We'll show you what to watch out for and how to avoid the pitfalls that have trapped investors in the past. By the end, you'll have the tools to spot the risks, cut through the noise, and make better decisions for your money, so you can ride the AI wave with confidence, not fear. First, let's talk about the tidal wave of money pouring into AI. Over the past few years, we've witnessed an unprecedented surge of investment, with billions of dollars flowing into artificial intelligence from every direction. Venture capitalists, governments, and corporations are all racing to stake their claim in what many see as the next technological revolution. The sheer scale of this financial movement is reshaping industries and redefining the global economic landscape. The stock market is being propped up by a handful of tech giants: Amazon, Microsoft, Google, NVIDIA, known as the Magnificent Seven. These companies are not just leading the charge, they're setting the pace for the entire market, with their valuations soaring to record highs. Investors are betting big on their ability to dominate the AI landscape, and their influence is felt in every corner of the financial world. These companies now make up over a third of the S&P 500's value, and their AI spending is staggering. Their combined market capitalization is so massive that it dwarfs entire sectors, and their decisions can sway the direction of the global economy. Every quarter, they pour more resources into research, infrastructure, and talent, fueling a cycle of innovation and competition. In just 1 year, they're investing more than $330 billion in AI, more than the entire economy of countries like Finland. This level of spending is almost unimaginable, and it highlights just how high the stakes have become. The race to build smarter, faster, and more capable AI systems is driving a frenzy of investment that shows no signs of slowing down. This spending fuels jobs and growth, creating new opportunities for workers and entrepreneurs alike. But it also makes the economy dangerously dependent on a few companies' AI ambitions. If these giants stumble or change course, the ripple effects could threaten entire industries, leaving workers and investors exposed to sudden shocks. If their spending slows, the ripple effects could be huge. A sudden pullback could trigger market volatility, job losses, and a slowdown in innovation, affecting not just tech, but the broader economy as well. The AI race isn't just corporate, it's global, with the US and China battling for dominance. Both nations are pouring resources into AI research, infrastructure, and talent, hoping to secure a strategic edge that could shape the future of technology and power. The IMF says AI could impact up to 60% of jobs in developed countries. That means millions of workers may need to adapt, retrain, or find entirely new careers as automation and intelligent systems transform the workplace. This geopolitical competition is pushing spending and risk even higher. As countries and companies race to outdo each other, the pressure to invest grows, raising the stakes for everyone involved and making the global economy more interconnected and fragile. The stakes have never been bigger or more uncertain. As the world pours money into AI, the opportunities are vast, but so are the risks, and the outcome is anything but guaranteed. Here's our first warning sign: the AI arms race and its massive, risky spending. Microsoft, Amazon, and Google are each betting tens of billions on AI, hoping for trillions in future profits. But if those profits don't materialize fast enough, confidence and stock prices could collapse. There's another hidden cost: AI's energy demands. By 2030, powering global AI could cost up to $3 trillion a year in electricity alone. That's a huge strain on resources and the environment. Imagine a casino where a few high rollers keep the whole place afloat. If they walk away, the casino crumbles. The entire market is now tied to these massive bets. Exciting? Yes. But it's also a sign of instability you can't ignore. The bigger the gamble, the bigger the risk. Our second warning sign is the money go-round between AI giants. Tech companies are investing in each other, creating a loop that can make their finances look stronger than they really are. For example, Microsoft invests billions in OpenAI, which then pays Microsoft for cloud services, boosting both companies' revenues on paper. NVIDIA sells chips to tech giants, then invests in those same companies, fueling more chip sales. This cycle inflates stock prices, even if real customer demand isn't keeping up. It's a classic bubble sign. Valuations propped up by insider deals, not real profits. If one part of the circle breaks, the whole illusion could unravel. Don't be fooled by impressive numbers. Look for real sustainable growth. Let's dig deeper into this financial merry-go-round. After Microsoft's investment in OpenAI spends billions on Microsoft's cloud, making both look like they're booming. Oracle, NVIDIA, and others are doing similar deals, creating a web of circular investments. NVIDIA's stock has skyrocketed, but much of its growth is tied to these internal loops. The real problem? AI services aren't yet making enough money to justify these sky-high valuations. OpenAI, for example, is valued in the hundreds of billions, but still loses money every month. When company values are based on financial engineering instead of real profits, that's a red flag. This is the kind of risky behavior that often comes before a bubble bursts. Our third warning sign isn't about money, it's about the limits of AI itself. AI's rapid progress has been fueled by training on nearly all the public data available online. But researchers warn that by 2027, we'll run out of high-quality data for AI to learn from. Once AI has read every book and website, its progress could stall. If improvements slow, the hype could turn to disappointment, and investors might panic. The entire AI boom is built on the expectation of endless growth. To keep advancing, AI would need to learn from real-world experience, not just data, a much harder challenge. Today's AI isn't ready for that leap. Ignoring this data wall is like believing a car can run forever without refueling. It's a risky assumption for your investments. So, is this AI boom truly different from the dot-com bubble, or are we just repeating history with new technology and bigger numbers? It's a question on the minds of investors, business leaders, and everyday people alike. In some ways, the answer is yes. Today's tech giants, companies like Microsoft, Google, and NVIDIA, are not just ideas on paper. They have real products, established customer bases, and billions in profits. Unlike many dot-com startups that were built on hype and hope, these companies are already deeply woven into the fabric of our daily lives and the global economy. AI is already transforming industries, making businesses more efficient, and creating tangible value. From manufacturing floors where robots work side by side with humans, to offices where AI tools help teams solve complex problems, the impact is real and growing every day. But despite all this progress, the warning signs of a bubble are hard to ignore. We're seeing extreme valuations, hype-driven investing, and companies with little revenue being valued in the billions. There's a global arms race for AI dominance, and sometimes it feels like everyone is chasing the next big thing, no matter the cost. These are classic ingredients for a speculative bubble: rapid price spikes, stories of overnight millionaires, and a sense that the only way is up. The truth is, AI is a revolutionary technology with the power to reshape our world. But just because the technology is real doesn't mean the current market surge will last forever. Every boom has its bust, and history shows us that corrections are a natural part of innovation cycles. A painful correction or even a crash is possible, maybe even likely. When excitement runs this high, markets can turn quickly, catching many off guard. The key isn't to try to predict exactly when the bubble might burst, but to be prepared for volatility and uncertainty. Have a plan, stay informed, and don't let emotions drive your decisions. Don't get swept up in the mania or the fear of missing out. Sometimes, the smartest move is to step back and think long-term. Stay grounded, focus on the fundamentals, and remember, hype fades, but strong businesses and sound investments endure. The smartest investors are those who can see both the promise and the risks, weighing excitement with caution. Be one of them, and you'll be ready for whatever comes next. Now, how do you protect your money in this uncertain environment? Don't panic or try to time the market. The best strategy is to invest consistently, no matter the headlines. Set up automatic monthly investments in broad, low-cost index funds. If the market drops, you'll buy at a discount, setting yourself up for long-term gains. Focus on increasing your income, so you have more to invest and more security. Look for promotions, side gigs, or freelance work to boost your earnings. Most importantly, diversify. Don't put all your money in hot tech stocks. Spread it across stocks, bonds, real estate, and maybe a little gold. Diversification is your best defense against bubbles. Stick to these timeless rules, and you'll weather any storm. Smart, simple strategies always win in the end. Let's wrap up. AI is exciting, but smart investors separate long-term promise from short-term hype. We've seen 3 warning signs: massive spending, circular money flows, and the looming data wall. Don't let fear or greed drive your decisions. Your goal is a secure financial future, built on discipline, not speculation. Keep investing regularly, increase your income, and diversify your portfolio. If a crash comes, see it as a chance to buy quality investments at lower prices. The market always recovers. Those who stay the course come out ahead. Ignore the noise, focus on the facts, and act with intelligence. You're in control of your financial destiny. By following these simple rules, you can thrive. No matter what the market does, you've got this.